Hi, it's Mike Power with Silver Range, and here's a quick look at junior gold exploration markets as of mid-November, and a look forward for Silver Range. First, quick word from our lawyers. Well, let's have a look at markets, see what investors think of gold exploration these days. Financings, our lifeblood. We'll have a look at option activity, see what the promoters are interested in, and finally, take a look ahead, both for the broader market and for Silver Range. Starting with markets, it's pretty clear we're in a prolonged slump. Markets peaked after COVID in 2021 and been on a slide ever since. This is the venture, which, in addition to having a lot of mining companies, has a bunch of oil and gas and biotech and whatnot. So it's not the best indicator overall junior gold interest, but maybe the CSE composite's a better indicator, and it's even more depressing than the venture. Basically, the patient's flatline for the last couple of years. Now, in terms of the gold in particular, here's VanEck GDXJ, which is an ETF of the more advanced gold juniors. And it has a more interesting pattern. Shortly after COVID, it had a peak and it was on a pretty steady slide into 2022. Then it bottomed and now it's on the rebound. But it's still trading at a significant discount to gold. Before GDXJ historically would lead gold, but then about June 2022, there was a crossover, and GDXJ has been trailing gold ever since. But we note that the divergence is closing. There's more volatility in GDXJ, mimicking the ups and downs of the gold price, but we notice that the curves appear to be converging, which suggests maybe there are better times ahead for gold. And I think GDXJ might be a good proxy for what some of the more sophisticated and bigger investors, say on Wall Street, think about gold. It's an easy bet. If you think gold's going to improve, and the juniors in particular are going to do well, starting with the mid-tier producers through the more advanced juniors, GDXJ is a good bet. So this may reflect smart money moving back into the market. Let's turn to financings. Money's oxygen in our business, and tracking financings is the very best way of seeing just how much oxygen is in the system. We follow all of the 45105 reports that are submitted to CDAR. So this is basically anybody raising money for mining exploration in Canada has to file one of these reports, and we track it religiously. And in the graphs, you're going to see these are all 6-week trailing averages because there's quite a lot of volatility in the bi-monthly to bi-monthly reports. Let's start with total financings raised. Our data extends back to last July, which we feel was the very bottom of the financing market. That's when it was quite apparent to everybody that there was a very serious problem in mine financings. So our data begins then. And as you can see, there'd been a couple of bumps. The most notable one was there was some very large financings done at the end of May. And interestingly, in the last 2 weeks of the reporting period here, which is the first 2 weeks of November, there was some very large financings done as well. There was basically 800 million raised by Aris and NGEX, in addition to some other largish financings. Now, looking at the total financings can be very misleading because there are these whale financings that come in, as you see here in May, and they completely swamp all the smaller financings, which are the lifeblood of the market. If we break down the financings by size of financing, we're looking at the greater than 2 million here in purple, and you can see they dominate basically the financing patterns throughout. And all of the smaller financings are just sort of ripples on the ocean here. So looking at the very large financings, as we pointed out before, is very misleading and not a good indicator of really what's going on in the market. When we start looking at the number of financings, again, bin by size, the very small ones in red and the very large ones in purple, we see some information because now we're starting to see how easy it actually is to close a financing. And as you can see, in July 2023, it was very difficult. It was only 40 and change financings closed, and now we're well over 100. And this suggests that market conditions have eased a bit and companies are finding it a bit easier to raise money. And you can see here from the breakdown that most of the financings are small. They're less than 2 million. If we look at the proportion of financings by size, the reds again are the very small, purple's the very big. We see some improvement in the last couple of months. There's more of the very large financings, the purples, the greens, the blues, and there's less of the smaller financings, the oranges and the reds, suggesting that the average size of the financing is improving, which we see, and that there's more money flowing into these larger financings. So that's a small, hopeful sign of improvement here. Let's have a look at the bottom end of the market. This is of particular interest to Silver Range because many of our partner companies start out here. Now, these financings are less than 2 million. They're a very small proportion of the overall aggregate financings, but they're pretty critical for indicating the overall health of the market. And as we go into November, we see there's an upswing. We note that in particular financings between 1 million and 200,000, that would be the blue and the green, are increasing as a proportion of the overall financings. And the numbers are increasing. We've come a long way since the bottom in July last year when we were down below 40 financings in this class. Now we're up to over 80. And as we go into the end of November, once again, we see an uptrend in the number of these smaller financings less than 2 million. And we are particularly gratified to see that the number of financings at the larger end of this range are increasing. That's the blue and the green. This would be between 200K and 1 million. So all in all, there's some reason for hope, but I don't want to overplay this. Historically, we find that we need to see the really small financings less than 200K amounting to less than about 25% of the total aggregate financings, and we don't see that yet. Currently, we're at about 30%. In addition, we need to see overall total financings averaging about 300 million every 2 weeks, and we're not seeing that either. We're about a half that number. So while there's some reason for optimism here, we're not out of the woods yet. We're still in the middle of a financing bear market. Okay, enough of financing. Let's have a look at option activity because that's the best indicator of where promoters see opportunities in the market. Here's our data compiled from StockWatch, and we're looking at property options by the commodity type, precious metals in red, that's where we work, and then base metals, battery metals, and uranium in the other colors. You can see that option activity has been generally subdued. We had quite a quiet summer. There was that anomalous peak in May. There were a lot of financings done then, a lot of options closed in May 24. That was anomalous. But in general, activity has been subdued. And what we're seeing in the fall is perhaps a reversion to the mean in part. The other interesting thing is if you look at the proportion of options by commodity type, that the proportion of gold financings is starting to increase, reflecting, and that's precious metals as well, so it's reflecting the improved gold and silver prices. Also note that the number of battery metal financings is decreasing dramatically. There was a big minor spike in early in September. There were about 6 options that were centered around antimony. This was after the Chinese embargoed exports of antimony, and stibnite was financed by the U.S. government, and promoters snapped up a few stibnite properties, but that little blip is superimposed on an overall declining trend in battery metal options. And uranium seems to be petering off as well. But gold-based metals are holding their own. So what's ahead? Post-election, we were surprised to see gold and silver prices retreat as much as they have, and they might go a little bit lower. And this appears to be in part driven by a move into crypto, which seems to be a popular subject with our incoming president. We see a broad market correction likely. There seems to be a divergence between overall economic activity and what the S&P 500 and the Dow are saying. And we think that there will be a bit of a convergence again, perhaps happening in January or February. We see no sign whatsoever of general market interest in precious metal juniors and exploration. You can see that in particularly in the CSE composite trends. There might be a bit of smart money moving in to gold via VanEck, GDXJ, but in general, we don't see investor interest plowing back into the junior market, trying to snap up the juniors. And without that interest, we don't see a very good market for financings and option activity going forward, at least perhaps until February. We think after the inauguration in the United States and the new administration gets in, we'll start to see where things are heading, and maybe that will spark some more interest in gold and silver exploration. So don't see much change until February. Well, what's ahead for Silver Range? We'd been operating on fumes for quite a while, but recently one of our partners, Silver 47, has gone public. We're a significant shareholder, and we'll be monetizing a proportion of our holdings in there. We're a prospect generator, not a mutual fund, and we seek returns from our agreements with other companies in terms of cash or shares, and use that to finance our activities. So thankfully, we look like we're going to be able to recap the company here in short order. We're cautiously optimistic about some future options that we have in the pipeline. Excalibur Metals, we hope will be listing in January, and we're cautiously optimistic that Broden Mining might be able to move ahead with their project at Farrell, perhaps in the next quarter to half year. In this quiet market, we're focusing on property sales and marketing. It's not a very fun job these days, but we think it'll pay dividends in the end. And with some new cash in hand, we plan on resuming field work in earnest, probably in the first quarter of 2025. So that's it. We look forward to better days, and we hope you'll ride with us. Thanks.